really just kind of the same old blocking tackling. We go to a local bank next door or a regional national bank that lends to self-storage or that specific property. So we found that that works just fine still, and you're paying between 7 to 8% potentially on a rate. For the more institutional quality properties, you're going to get down to the low sixes in this market right now.
What about in regards to the structuring of the sale? Are you guys with financing going on right now? It's more expensive than it used to be.
Yeah.
Financing is always going on, but with the increased interest rates, and maybe the a little bit higher down payment requirements, about 5% more what we're seeing. What are you seeing with self-storage financing, and how are you structuring maybe either seller carryback deals with the sellers, or what are you doing there to make it a win-win for everybody?
Yeah, that's a good question. We actually launched a debt fund to help us finance new construction and existing purchases a little bit more efficiently. And so we've launched that strategy. The other strategy is really just kind of the same old blocking tackling. We go to a local bank next door or a regional national bank that lends to self-storage or that specific property. So we found that that works just fine still, and you're paying between 7 to 8% potentially on a rate. For the more institutional quality properties, you're going to get down to the low sixes in this market right now. Class A stuff with bigger loans and better product, maybe from the life insurance or life cos that are lending to self-storage. But I would say that fundamentally things have not changed all that much from prior to the interest rates going up from a structure standpoint, right? We're going out, we're seeking a loan, we're getting first position on the property to a lender, whether that's a local credit union or a local bank. Or a national bank. That really hasn't changed all that much. But you're right, more equity is required, and that makes for a less efficient capital stack, because not only are you putting down more equity, which reduces returns for equity investors, but also it reduces risk as well, because now you don't have as much debt on the property because the bank is now requiring you to put down more money, and that's to keep their DSCR. Their debt service coverage ratio in line with what the higher interest rates are putting on the property. So bigger down payments, higher interest rates, and lower cash flow is what we're seeing as a result of that, right? Because if you have to put in more equity and it's a higher interest rate, generally you're going to see a lowering of cash flow. So there's that. And there's always the opportunity in any market to do seller carryback. I think that's something that's always on the table for negotiating. Something that we can certainly try for, something we've done in the past, and that's something that can play very favorable if the seller is willing to do that, because you might get a lower rate and you might get better leverage terms to produce potentially better income.